So right now we have two major opposing forces in liquidity. The Federal Reserve, because they're reducing their balance sheet, are pulling liquidity out of the market, and that basically means that rather than them buy the bonds that are being issued by the government, the private sector has to buy those bonds, and they're letting bonds roll off their balance sheet, and so there's actually more bonds entering the market than there would be just from issuance alone. So that's a liquidity drain on the market, and historically that's not very good for most asset prices.
In a recent interview with Yahoo Finance, investor Lynn Alden shed some light on the forces currently at play in the market and why she believes this sideways action will continue. Alden discusses the upcoming Fed meeting and the expected 25-point rate hike. While tighter monetary policy can reduce private sector activity, background fiscal deficits actually act as an inflationary force. Alden believes that inflation will continue to be a challenge for the Fed, and it is likely to return anytime there is a reacceleration in growth. Let's listen to Lynn.
So right now we have two major opposing forces in liquidity. The Federal Reserve. On the other side of that, you have the Treasury General Account that has generally been draining since the middle of last year, and that's actually a net positive for the market, because basically you can imagine as money is kind of stuck in their cash void, it's not really being used, and as they draw it down, it goes back into the market. And one of the reasons they're drawing it down is because of the upcoming debt ceiling impasse. Because they're unable to issue new bonds, they instead have to do extraordinary measures, such as draw down some of their existing cash balances. And so that's actually been somewhat of an opposing force. And so if you look back last year, you had falling liquidity for most of the year. That was in line with the market continually going down. And then starting in the beginning of quarter four of last year, you've had more of a sideways liquidity environment because of these opposing forces. And so it's not surprising you've seen kind of a choppy sideways market ever since then.
The Fed's goal to bring inflation down to 2%, do you see that happening?
I think it could happen temporarily, but I think they're going to have struggles doing it longer term, because it's another area where it's being opposed, right? So tighter monetary policy can reduce some of the private sector activity, right? Obviously, very interest rate sensitive industries such as housing, such as unprofitable tech. These areas are obviously slowing down. Fewer workers, overall less consumption, less activity, deflationary asset prices. That's in line with their goal. On the other hand, because we're still running these background pretty large fiscal deficits that actually grow larger as interest rates increase, because the government's paying more interest on its existing debt load. That's actually a background inflationary force, because that's more money that's going into the economy. And so I actually think that when you look out several years, they can temporarily get inflation down if you have a recession or a pretty severe kind of a slowdown in growth. But anytime they want to have a reacceleration in growth, I think inflation's likely to return. I think that's probably going to continue until either you bring in a lot more energy production globally, or they rein in the deficit as a percentage of GDP to a significant degree.
To watch the full interview, check out the link below. Do you agree with Lynn's thoughts on the market? Do you see more rate hikes on the horizon, or will the Fed have inflation tamed by the end of the year? Let us know in the comments. If you want to see more on the world of crypto and tech, make sure to like, subscribe, and hit that notification bell as we put out daily content. Thanks for watching, and we'll see you next time.